welcome to the next episode of our panel discussions at MC Squared Finance. Today's topic is portfolio performance metrics, and we are being joined by amazing experts. We have Duke, if I'm correctly pronouncing your name, from Titan Trading Platform, and also we have Daniel from BlockSquare. And of course, as always, joined by Chris, the co-founder of MC Squared Finance. Before we get to the topic, I'd like to invite our guests to provide a little bit broader elaboration on themselves and their projects. And of course, thank you everyone for joining us, because today is a very special and unusual day, and it's very busy, especially we've seen the market action following the political events, and but we are still here as always for you. So let's start with Duke. Duke, please, would you give a brief introduction on Titan Trading and also on yourself?
Yeah, sure. Thank you for having me today. My name is Duke. Now I'm currently working as a quantitative researcher at Titan Trading Platform. I specialize in making low and mid frequency, and also in portfolio management. And I focused on developing and refining strategies that optimize risk and return. So now I'm excited to be here and share insights from my experience, and I hope the knowledge I bring will be valuable to everyone. Turning into this region, hosted by MC Square Finance. Thank you for having me today.
Thank you very much. And also, I'd like to invite Daniel to refresh a bit on yourself and also on BlockSquare, because we're, having audience, with some new people joining all the time. So definitely happy to see you again.
Hi, yeah, good afternoon. Thanks for having me. So my name's Daniel, and I head up risk for BlockSquare. BlockSquare is a tokenization infrastructure platform for real estate. So businesses of all types, from startups to large enterprises, can use BlockSquare's solution and APIs to digitize value of real estate properties, launch investment platforms, and connect people to tokenized real estate deals all over the world. So my role is head of risk at BlockSquare, focusing on ensuring we have the right processes and systems in place for tokenizing real estate, onboarding real estate, and then ensuring that people who choose to hold tokens in real estate are able to obtain a clear line of sight to the risks around real estate.
Awesome. Thank you very much. And also, I would like to ask Chris to once again, remind everyone what MC Squared Finance is about, and give a little blurb before we get to the topic.
Sure, happy to. With MC Squared Finance, we want to make your perfect DeFi terminal. As a trader, there's very simple things that you have to do. You have to analyze your portfolio to get to the right assumptions. You want to discuss it with your peers to get to the right conclusions, and then have a simple and safe way to execute the changes into your portfolio. We think that all three things are currently broken in DeFi. And that's basically what we want to fix. We want to analyze your portfolio in a way that you directly get the right matrix, giving you right actionable actions, like that you can check out who are other experts trading the same assets as you, but make more returns, and how do they do that. That you can discuss it with your peers in a secure and safe way, as everything is on-chain verified. And then simply executing cross-chain, multi-asset, multi-protocol trades with a single signature over our smart portfolio infrastructure. And that's basically what we're building. We launched last week our public prototype, where you can finally see all the tokens on public pages. You can add your wallet and see all the insights, and we'd love to get your feedback on what would you need to get started trading with MC Squared Finance.
Awesome. Let's get into it. And before we get into the discussion of what specific advanced performance metrics there are. Let me first ask you the question, like, why these additional performance metrics are needed at all? What do traders get by using them instead of just simply, for instance, knowing like what was their TVL, how it's changed, what's the percent increase, so what pitfalls they may avoid, if any, and how does it help them to stay, in good shape? I believe that Daniel could, start, giving an answer with regards to this. I believe Daniel's profile also fits very well to kick off this discussion.
Yeah, sure. I'd be happy to jump in there. So really, I think if we start by looking at what these portfolio metrics are, I'd really describe them as tools to help evaluate how well an investment portfolio is meeting those objectives. Now, broadly stating, I'd say those objectives either fall into trying to maximize a return for a given level of risk or trying to minimize risk for a given return over a certain time horizon. And when we're looking at these advanced performance metrics, which we find in traditional finance, I think they're much needed in the crypto space and the DeFi space, particularly because of the levels of volatility. Those levels of volatility are crucial when determining levels of return, as opposed to looking at simple returns, for example, which don't factor in the level of risk that's being taken on in order to achieve those returns. It's crucial that we apply some of those advanced metrics to evaluate the level of given risk for those returns.
Awesome. Would anyone like to add on this? I believe maybe Duke has some additional thoughts on this.
Yeah, I totally agree with Daniel, because portfolio performance metrics are essential tool that help the investor assess the health and resilience of the investment. While simple returns give us just a quick bill of profits and losses, they don't account for risks taken to achieve your returns. This is where the more advanced metrics come in. So, looking beyond just raw returns, help investor understand the investment risk profile, their efficiency, and how it's risk so provides a more holistic view to make informed decision, especially in the high volatile markets like cryptocurrency. The specific metrics used depend on the investor goal and risk tolerance, and I will discuss with Daniel.
Yeah, I would totally agree, especially about the volatility. Although sometimes when I check, some stocks, they are also increasingly volatile over the last few years.
Yeah.
Even, some stocks of more conservative kinds of businesses, I'd say. But okay, since we're delving into that territory, I'd like to remind our audience that nothing that you can hear during this session is financial advice. Always do your research, always or consult your financial advisor. But yeah, we are here to discuss. We're here to hear the expert opinions and to get some extra knowledge on this. So let's get to these portfolio performance metrics themselves. So can you tell us like what are, how to say, the popular ones, the ones that are most often applied and how they differ? Perhaps Chris could provide us with several examples on those, of what those are.
Yeah, sure. Happy to do so. Like in terms of metrics, I think the two absolute key ones are your ROI as well as your max drawdown. And which max drawdown is actually a really underused metric because like everybody in crypto looks for the upside and how big the returns are, but rarely actually how big the risks are. Like it's easy to make very high returns when you also have very high drawdowns. Like basically when you fluctuate a lot But this makes it more and more a gamble. So if you want to get serious, focus on having very low drawdowns and rather have a good upside in your trades. And the better you can handle it, the better you will do on the long run. Here also very interesting is calculating the 0 to 0 ROI. So if you're a good trader, then often you want to have the knowledge of what is your return since you now entered this asset, even if you traded it before. And this is also like a big issue even on centralized exchanges, as a lot of them actually display this information wrong. So we know a lot of traders who have an Excel sheet on the side, export all the trades, and then do the right calculations in Excel sheet. And that's still a pain in the ass in the whole ecosystem. And otherwise, it's about like a lot of people also look at how much win rate you have, so how many of your trades actually return positive, which is also a very interesting metric in your portfolio. And then it's what we see, what is also very underutilized is personalized metrics. Basically, if you compare your assets with each other. Like in the crypto space, you get everywhere, this is a token, this is your current asset, what you're holding in a token. But it's actually rare that you get information about how this is handled compared to other tokens in your asset class. Like if you only hold meme tokens, you have a different risk appetite than if you only hold blue chip tokens. And that should be accounted for, like understanding what is the highest risk token currently in your portfolio that you maybe should adopt, or if you are exposed into a single like asset class and type. These things are things for more advanced traders that often a trader has to keep in mind because currently no tool tells them.
Thank you. I'd also like to ask Duke, like what specific portfolio performance metrics you follow. Maybe you can give us some examples or some elaborations, like why exactly those, or maybe you could also elaborate a bit on how those are derived, like is it a ratio or something else, so that we can have extra context for people who are a bit new to this.
Yeah, sure. I also use sub ratio and McDonald like Chris, because it's one of the most prevalent metrics in the quant trading world. But I want to contribute another value metrics that I use on regular basis. It's a return to McDonald ratio. It's quite simple, but really efficient ratio, because it's measures return relative to the worst historical decline. And this helps the investor compare the different portfolios and strategies to determine which offer the most sustainable and risk-adjusted returns. And also, one of the metric I take a look at is drawdown time. It's just a time to take for portfolio to recover from a previous peak. Is also from informative. A portfolio with a short drawdown periods may indicate a resilience, while the long drawdowns could imply that the portfolio struggle to recover. So it's tell that it's a potentially vulnerability. Yeah. So I also want to add some contribution about the benefit of metrics that in the hedge fund or in the quantitative trading environments. For me, advanced metrics help evaluate how well strategies are performing under various market conditions. So it can guide adjustment for risk management. So yeah, this metric also offers valuable insight when when we want to combine the trading strategy of just we combine the assets together to make a lower risk portfolio. Yeah, that's it.
Thank you very much. Also, I'd like to address Daniel and address specifically, Daniel, your experience in the equities market. So, how things are different, if any, when analyzing portfolio in equities, and maybe something has changed over the years, and like how do you currently, watch how traders analyze their portfolios currently in the crypto space?
Yeah, well, I think the metrics that were discussed there by the other speakers all sound feasible and good. I think one thing that's used quite consistently throughout traditional markets is benchmarking. If you were an investor who was looking to hold a portfolio of assets and to manage them actively rather than passively, one of the things that it's reasonable to try and determine is what proportion of your returns is based on the technical skill of your trades as opposed to the overall market. And in the traditional financial space, this is measured through your beta. So, your variance to the benchmark portfolio or the overall market. And I think this is certainly used throughout various different types of funds and investment groups in the traditional financial space, even in their sort of public-facing prospectus information, as it shows their ability to apply technical skill to provide abnormal returns to the market. Now, it's a little bit trickier to do at the moment, I would say, in the crypto space in terms of trying to identify an adequate benchmark of the market that you can base your abnormal returns against. So I'd say that would certainly be benchmarking would certainly be a useful, or could be a useful tool here in addition to the other metrics that were mentioned. But what's crucial in getting that right, I think, is determining what the best benchmark is to take.
Yeah, absolutely. And I would say, I think Chris would say that in crypto world, the benchmark is the Bitcoin price. Am I right, Chris? Because basically, because of Bitcoin dominance, which
Yes.
consists more than half of the whole market cap of the whole crypto market. It kind of makes sense, at least when you try to fill it. Yeah, go on.
Now, as we enter the bull run, definitely we see the Bitcoin dominance and how it increases, and that probably will even increase over the next week further. So if you are like in the crypto space fully, if your token is a crypto project that you work with, then this will be your reference to measure against. And you should be better than just holding Bitcoin or running a basic swing strategy. That said, for sure, Bitcoin then is a high risk asset. And so everything that you reference to it is also in a high risk segment. If you work with other things like liquidity provisioning, focusing on stables, etc., then maybe you wanna have more or less the S&P as a reference. But I think that it's a very interesting topic to what are you measuring against? Because I would say that probably 80% of all the traders actually have worse results than just holding a simple S&P index token or ETF. And that also means, which brings me to the topic, that you should be true to yourself when you measure it. Like saying, oh yeah, I had really good 10 trades yesterday. It was so fun. It was so exciting. But then you actually did 100 trades. You can be overly optimistic about the 10 that actually worked out. So I think being true to yourself, which often comes together with trying to work with less emotions and rather work with the data is a very important part for traders.
Yeah, and I think you very well landed for the next question, because it's exactly about the balance between like enough metrics and having too much. Just like with technical analysis, you may have like 100 indicators and very much confuse yourself and overburden. So with portfolio performance metrics, when you assess the whole portfolio, like is there a good combination of performance metrics that would actually help you to wrap your head around uh, like the subject matter, your portfolio, and the market that you're trying to analyze, and like if there is such combination, like what can it be? I Let's start with Duke. I believe Duke can handle this question pretty easily.
Uh, yeah, yeah, sure. Because I think advanced metrics are particularly useful when you evaluate complex portfolios and many risks are navigating volatile markets. As Chris said before, that's the Bitcoin and the SP performance is one of the most important benchmarks in our in the cryptocurrency market. So yeah, it's also a high volatile market, and the simple return might show, um, in the matrix, simple return might show attractive gains or step loss, but they don't reveal how much risk was taken to achieve the result. Um, so the advanced metrics like Sharpe ratio and market data clarify whether returns are stable and sustainable. If portfolio might suffer significant loss during the downturns. Um, so the key is how to beat the benchmark. So we have to manage the risk efficiently, in my opinion. Uh, because when you have a strategy with the low drawdown, you can leverage it like the 5 times or 10 times. So you can more easily to beat the market, because the return of the Bitcoin and the SP 500 is really hard, and it's really hard to beat, because last year 20% hedge fund um, lose to just a simple benchmark. So I think when we combine the risk management in the high return market, like in the cryptocurrency market, we can achieve our goal. Yeah, that's it.
Thank you very much. I wonder if Daniel has like any additional opinion on this.
Oh, there. Yeah, no, so I was just thinking over the previous speaker's answer there. It's very interesting. In terms of specific combinations of metrics, I wouldn't be sure on which ones would make the best combination. I would say it's probably important to be wary of what you could call vanity metrics, and I suppose simple returns is perhaps could be defined as one of those, where if we chop up figures, you can pretty much chop them up anyway to get the result that you'd like in terms of producing a percentage ratio or figure that that serves your vanity. So remaining objective is probably quite crucial there. In addition to that, when combining various advanced performance metrics in your portfolio, you do of course run the risk of complexity there, over making things way too complex to understand. I mean, of course, there's people like the good guys on this talk today who are developing platforms that can help take away some of the complexity there, which is great. But it's definitely something to look out for when applying multiple advanced metrics, I believe.
Totally. So it's very important that you mentioned the risks because, like, what can be other risks connected with, applying, certain metrics in the wrong way or reading them in the wrong way or maybe, getting wrong signals. So, and like how to, uh, figure that out in advance. Perhaps you could also give a few more examples of vanity metrics and also elaborate a little bit more what makes them not as useful as some people think.
Yeah, sure. Well, I mean, the idea of looking at just at a simple return, though might be considered a vanity metric, in the sense of you may have yielded a higher return than your benchmark, for example, that being Bitcoin. But what levels of risk did you take on? And if we translate risk down to volatility, what levels of volatility did you take on to achieve those abnormal returns against your benchmark? And were they way beyond what was within your parameters? You may have taken on 3, 4, 5 times the volatility and the risk of, say, Bitcoin, only to achieve a marginally abnormal return to Bitcoin. So actually going in the deeper to find those metrics that give you a much clearer line of sight to the decisions you've made can be really helpful.
Thank you. I'd like to pause for a moment and remind our audience that you can ask any questions related to this topic in chat sections of the live stream on YouTube, X, Telegram, and LinkedIn. If you're watching this on Discord, then we won't get the questions here on our feed, so you should get to one of those platforms I mentioned above, and we'll try to address them as long as they're relevant. So, and let's continue. So perhaps there are some other known risk limitations to those metrics known to Chris, if any. Maybe some interesting case studies you've heard of. Maybe somebody misused them. I don't know, or was too confident.
Like I think it's also the time frame that you're trading, and it's that like things look very different if you look at very short candles and very long candles, and also who do you trade against? Because the shorter your time frame, the more you trade against other traders. So you need to know what are their gains, what are their benefits compared to your own ones. And if you are focusing on the long term, it's much more about like focusing on macro and general trends that are happening. I think that a lot of the signals that you get, like especially if we talk, for example, about social signals, like what is the sentiment that people say on Twitter and on other social media about a token, about an asset class, that works very well if that is focused on it, like if you talk about meme coins and sentiments there. But that does not work very well if you talk about very big projects and blue chips, because here it's much more important what then macro is talking about, like what are like then the key institutions, even like central banks, are talking about different topics. They have a much higher influence than what people are talking on Twitter. And I think that you have to like really see what signals are right for what you are actually trading. And there's not like this one is totally wrong or totally right, but this one is it. And maybe one note here, if you find traders anywhere telling you this is how you can make 100% in a day, it's not true. Like if you see these things somewhere, then that's a people who make 1,000 trades. One of them makes 100x return, and that's then the only one that they present, because they don't make money actually with trading. They make money by getting people to trade.
Selling platforms and subscriptions.
Selling subscriptions, selling platforms. So if you're the product of a trader, then probably the trader is not so great. And I think that's what I would say is, especially in this market with a lot of uncertainty and a lot of like unverified information, this probably I would say is the biggest risky signals. That includes all the signal groups, especially if the premium signal groups. It means they don't make money with the signal, they make money with you.
Right. So, and I think that gets us to the next more, I'd say, I don't know, practical, non-practical. It's still like non-financial advice for everyone. But let's imagine, for example, that you, Duke, are tutoring some, I don't know, beginner traders or beginner analysts. So what kind of advice would you give them when you are suggesting using certain metrics and how to apply them, like how they should incorporate them into their analysis? What would you say them? How to start?
Yeah. So based on my experience, my top advice for the beginners incorporating advanced metrics into the portfolio analysis is to start by understanding your own risk tolerance and selecting metrics that align with it, because not all the metric is useful for you. For investor comfortable with the higher returns, the strategies with the higher returns, but potentially larger drawdowns and lower Sharpe ratio may be suitable. But in contrast, more conservative investor may focus on the strategy with the high Sharpe ratio and low drawdowns, prioritizing the stability over aggressive returns, especially in hedge fund, because now I'm working in as a quantitative researcher, so I have to make sure that my portfolio has low volatility, so I can make the sustainable profit for our customer. And secondly, using the MaxDAO metric is particularly helpful in determining appropriate level of leverage. So it can guide you in managing your portfolio risk exposure. Also, rather than relying on single metric, you can select a balanced set of metrics that reflect your specific goals and risk tolerance. So it will provide you a more reliable view of your portfolio performance. So from my experience, the portfolio for the mid-frequency and low frequency has the sharp excess to the MaxDAO below 10% is great. So, and finally, remember that the market condition evolve. So because many more intelligent investors and traders come in the cryptocurrency market every day. So it's really wise to periodically revisit and update your metrics to ensure they still reflect your portfolio needs and current environment. So this approach allows for the better informed adjustment and risk management over time. Yeah, that's my advice for the new buy in my field.
Totally. Thank you very much. I think it was very fulfilling.
Yeah.
I wonder, Daniel, if you have some additions to the advice given by Duke, maybe something based on your past experience and also some knowledge.
Yeah, so I don't think there's any advice that I would have to any one individual in regards to any type of sort of portfolio management in that respect. I think more broadly talking about the market, I think there are several steps that could be taken to improve the overall market infrastructure to make it more readily manageable for the investor. Primarily, I think the encouragement of a more efficient market. By efficient, I mean the ensuring that all information is transparent and presented to the market at the same time. This has remained one of the foundational pillars of traditional finance, and something that it's endeavoured to do. It's not always achieved it, but it's certainly endeavoured to be as efficient as possible. And this is seen as, really one of the backbone of that. I think the improvement of infrastructure within this space can help ensure that the market becomes a lot more efficient, and by doing that, we can facilitate a much more welcoming space for people.
Thank you very much. I wonder if Chris has any extra advice, because we will go to the outro part of the session.
Like, generally, I would say for trading, start simple. Be very aware who do you follow. Start with blue chip assets. Never invest more that you can actually lose, because in the tough part is, as a trader, you will probably start losing before you understand it and start earning. So make sure that everything that you can lose, everything that you invest can be lost, and that you see this as a learning path. So start with 2 small investments, 2 small bets, to make sure that you train well. Start rather with the blue chips. Learn how to read candles very well with TradingView, which is nearly used by everyone. It's the golden standard. And find 4 or 5 traders that you really believe have a good strategy and share genuine content to follow and to learn from. I would say that's the basics.
Awesome. Thank you very much. So I think we're coming to an end of the session. We thank all of our expert guests, and as always, we deliver you more panels related to DeFi, to trading, to investments in crypto, trying to run the sessions every 2 weeks. And also, as always, check on our developments, in Titan Trading and on Blocksquare. And if you are a professional trader watching this and want to learn how you can collaborate with us and additionally build your own public image and gain certain following, then we have Trade in Residence program. If you're beginner traders, register, check your portfolio metrics and see how you can enhance it. So as always, we are here for you, making DeFi space more approachable for everyone. And see you next time in 2 weeks. Thank you very much.